I believe, beginning the recording. Try to turn off the transcriber. Have one more minute. All right. It is 12:01. I think in the interest of time, we'll get started. My name is Mark Cooper. I'm the director of the U.S. Department of Commerce office here in Indianapolis. The mission of the U.S. Department of Commerce is to promote exporting globally. We are the frontline trade promotion agency of the United States government. We are connected to all the U.S. embassies abroad, around the world. When it comes to exporting, we know the territory. If you know me, you know one of my favorite little catchphrases is that international trade is a contact sport. And I say it all the time. So we hope that today we are contacting you and we are interacting, and we have a great number of speakers, or I have a speaker on board that will tell us a lot of good information. So without any further ado, I'm going to turn the microphone over to my friend and colleague, Joe McMurray, one of our Indiana District Export Council members, to start today's program. And he will give us the lowdown on how our program will run today. Joe, please take it away.
Thanks, Mark. Good afternoon, everybody. Welcome to the Indiana District Export Council webinar of the month. We do provide this every other month. We pick a topic and do educational webinars to help our manufacturers, organizations, anyone exporting, whether service or products, help them and offer that help through a variety of different mechanisms. The Indiana DEC is a not-for-profit organization, DEC standing for District Export Council. There's one in every state, and they operate under the auspices of the U.S. Department of Commerce. As Mark said, he's the director for the state of Indiana, and so we partner together and we offer Indiana exporters a variety of different avenues to help them to grow their export business, and we do that all year round. And we do have a programming of, as Mark had said earlier, about every other month we do a webinar, educational webinar. It is being recorded, as Mark said, and it will be posted on the DEC website. I would encourage you to seek that out. It's at www.indianadec.org. And I believe a colleague of ours has already put it in the chat, so you could look there as well, a link to the website. Joe McMurray is my full name. I am with Purdue's Manufacturing Extension Partnership. We have been partnered with Mark. Mark and I have been working together for several years now, and Purdue offers what's called an Export Tech program, which helps small and mid-sized manufacturers, predominantly smaller manufacturers that aren't currently exporting or are incidentally or accidentally, sometimes we call it, sending stuff to foreign markets, and help them develop a strategic business plan for entering that given market. We have a lot of people that on the deck that are present today. In the sake of time and not missing anyone, I'll just say thank you to all the DEC members that are present today. We appreciate your support of this. I'd like to introduce our speaker, Eric Flickiger. I pronounced that right, Eric? Eric is a member of Forvis International Tax Services, and he has a ton of experience at compliance and consulting with regard to global intangible income analysis, foreign tax credits, domestic international sales, corporate taxation, subpar F, which if you're in that arena, you would know what that means. I'm hoping he'll comment on that. And income tax treaties for multinational companies. He is a member of the American Institute of CPAs, Indiana CPA Society, and Beta Gamma Sigma, and has degrees from Ball State University here in our own Indiana in both bachelor's and master's in accounting. At that, I will let Eric take it away.
Thank you, Joe. I appreciate that. And thank you, Mark, for having me here today. I'm going to share my screen. I've got slides that will help lead the discussion today. And the focus today will be on tax incentive programs for exporters. So these are tax ways to reduce taxable income for exporters who meet certain qualifications and have qualifying activity. I'll just go ahead and advance the slides here. So we're going to focus on two regimes today. One is the Domestic International Sales Corporation. It's commonly referred to as the acronym DISC or IC-DISC. And then there's also a fairly new incentive that's available to certain U.S. taxpayers who are exporting products and services called Foreign Derived Intangible Income. This was a regime that was put in place at the end of 2017, beginning effective January 1, 2018, with the Tax Cuts and Jobs Act. But first, what I wanted to do was really provide a background of U.S. tax export incentive history, because I think that's important to understand how we got to where we are today. I'll make a quick comment here. I know, Joe, you mentioned Subpart F. The Subpart F regime is a very old regime. It's put in place to discourage, I guess, the act of a U.S. company, making a product and selling it through a zero tax or low tax jurisdiction. So putting all the profit outside the U.S. and not subject to U.S. tax. So Subpart F was something that was put in place to prevent that. Along the way, Congress realized that it would be good to provide an incentive to our U.S. exporters who are making product in the U.S. and selling to foreign persons. So that's where the Domestic International Sales Corporation regime was started, and it's been in the Internal Revenue Code since 1971. So this is a regime that's been around for over 50 years. Originally, for the first, I would say, 10 to 15 years, it was used as a temporary benefit for companies. So this was a way for very large, multinational corporations that were manufacturing product in the U.S. and selling it outside the U.S. to put profits into this DISC entity and defer the U.S. taxation on those export profits, sometimes for as long as possible for an indefinite period. In the mid-'80s, this caught wind of our trading partners, and they argued that the DISC was an illegal export subsidy. So Congress made some changes to the DISC regime. The statutes remained on the books, but the benefit of deferring the export profit was greatly reduced. So it was reduced from no limit to only income related to $10 million of export sales. So that took away the benefit from a lot of the larger corporations that were taking advantage of the DISC since inception, since 1971. So there was a new regime that was put in place called the Foreign Sales Corporation in the mid-'80s. When that happened, most companies moved away from the DISC regime. So it fell out of favor as far as a U.S. export tax incentive, but it remained on the statutes. So it never was changed. over the years, there were several. Yeah, sorry, Joe. Yeah, if there are questions throughout my presentation, you can feel free to ask those through the chat feature. I'd be happy to answer them as we go through the presentation. Over the years, the replacement of the DISC regime, the Foreign Sales Corporation, was again challenged by the EU. Ultimately, it was repealed, and Congress put in a new export incentive called the extraterritorial income exclusion, which was immediately challenged in the early 2000s. So during all this time, the DISC remained in place unchanged in the IRS statutes. And in 2003, President Bush enacted favorable capital gains rates for individuals. And along with that, dividends that were considered qualified dividends are able to receive favorable capital gains rates. At the time, this dropped the qualified dividend rate from 35% to 15%. So at the time, ordinary income was taxed at 35%, and now qualified dividends were being taxed at 15%. And this created an opportunity, and we'll walk through how this works later on, but to create permanent tax savings for companies that were privately held, producing product in the U.S. and exporting that product outside the U.S. In 2004, the extraterritorial income inclusion was repealed and phased out, and IRS became aware of the strategy that was put in place to take advantage of the DISC and qualified dividend rates. It was quickly challenged, and it was dropped as far as any proposed legislation to repeal the DISC regime. And in 2012, the IRS issued the DISC audit guide. So this was a guide for the IRS that the IRS put together for its agents to successfully audit a DISC tax return. So this effectively put into was a seal of approval from the IRS that the DISC strategy worked. Essentially, they were trying to make sure that if somebody was implementing the DISC strategy, they were doing it correctly. So along the way, in 2013, we had.
Hey, Eric?
Yes.
I apologize. We did get a question, and I apologize, Teresa, we didn't get it mentioned earlier. As you go through your presentation, we also want to know if you all help with import tax, not just exporting, but importing. Will this cover that whole gamut?
No. So we, at Forvis, we do not have import tax specialists or customs and duty specialists. That's usually law firms that can handle that. So we have several law firms that we can refer you to, but we haven't invested in that specific area with our firm. So this presentation will mainly focus on export tax incentives.
Okay, thanks.
Yep. So going back to early 2013, the DISC regime was in place. We were using it for a lot of our clients. Tax rates changed a little bit. The ordinary income rate went up. Qualified dividend rates went up as well. And the Medicare tax on net investment income was put into place. So that applied to qualified dividends as well. So this made the highest ordinary rate 39.6% for taxpayers, and the qualified dividend rate was at the highest was at 23.8%. And finally, in 2017, with the Tax Cuts and Jobs Act, the proposed legislation in November 2017 actually had a repeal of the DISC regime in that legislation, and there was a large push by several lobbying groups, including the S Corporation group of S Corporation of America, a lobbying group that I guess helped Congress realize that the DISC is really a regime put in place to incentivize U.S. companies to make product in the U.S., create jobs in the U.S. And once they realized that, the repeal of the DISC regime was taken out of the 2017 Tax Act, and the DISC was retained with the Tax Cuts and Jobs Act. So since 1971, the DISC has been in place, and it still is in place today. The 2017 Tax Act reduced the ordinary income rate to 37% and also created a 20% pass-through deduction for individual owners of a pass-through entity. So when I say pass-through entity, I mean an S corporation or an LLC taxed as a partnership. Those individuals further reduced their business income from the highest rate of 37% to effectively 29.6% by taking advantage of this 20% deduction. The corporate rate was reduced to a flat 21%, and the qualified dividend rate remained the same. So it stayed at 20%, and the 3.8% net investment income tax is still in place. So this is just a quick overview of the Forvis IC DISC services. I'll just quickly glance over this, but we have a dedicated group just for this particular practice. It's a practice that benefits a lot of our clients. We have over 130 clients that take advantage of the DISC regime. We've developed our own software to perform the calculations. So we have invested heavily in this area, and it's created a significant amount of savings for our clients over the years. Okay, so the DISC itself, just generally speaking, is a separate entity from the operating company that exports product. So when you take advantage of the DISC, you have to set up a separate legal entity. It can be a company with substance. It can have employees, customers. It can hold inventory. But most of our clients are setting up a DISC, and it's really just a shell company, a paper company with no substance, and that's perfectly allowed in the IRS regulations. The IRS regulations say specifically that a DISC does not have to have substance like a typical company, and it's really just to take advantage of this specific incentive for exporters. So most of our clients have a DISC that has no employees, it has no inventory, but it's permitted to receive a commission from the operating company, which we refer to as the related supplier. So that related supplier pays a commission to the DISC every year. The related supplier receives a tax deduction for that commission paid, and the DISC recognizes income. But as long as the DISC remains qualified, it's a tax-exempt entity, so it pays no federal income tax on the commission income that it earns. And that commission amount, generally speaking, is the greater of 4% of gross receipts that the related supplier generates from its export activity, or 50% of the taxable income from the sale of export activity. So when we go through and provide services to our clients, we look at the related supplier's export activity for the year and apply these two methodologies to compute the commission amount that can be paid to the DISC. And again, that commission generates a deduction that reduces ordinary income and is not taxed as income by the DISC because the DISC is a tax-exempt entity. So, like I said, that deduction reduces the taxable profit of the related supplier. Generally speaking, at the highest ordinary income rates, that's a 29.6% benefit. So if we had $100 commission, the benefit on a $100 commission would be $2.96. That's the tax savings that we would generate from that deduction. The DISC then pays no federal income tax on the commission. And then it can distribute its earnings back to its shareholders, which oftentimes the related supplier is the 100% owner of the DISC. So the commission gets paid to the DISC, and then the earnings get distributed out of the DISC. And that distribution, when it comes out, is a qualified dividend, taxed at 23.8%. So we get a benefit of 29.6%, reducing our tax, and we have an increase in tax of 23.8%. So this is a tax rate arbitrage, reducing our ordinary income, which is taxed at higher rates, and effectively converting that into qualified dividend income. Again, the DISC profit is the greater of 50% of the profits on the sale of export property, or 4% of gross receipts. But we can actually go into a lot more detail when we do these calculations. So a lot of times what we'll do is we'll gather the company's export sales for the entire year on a transaction by transaction basis. So we'll look at each individual export transaction and apply the 50% or 4% methodology. And what that does is there could be some transactions that are less profitable, that where the 4% method is a better answer, and some transactions that are more profitable, where the 50% method is the better answer, and you can pick and choose by transaction which method you want to use. Additionally, there's rules that allow you, this is the marginal costing rules here, that allow you to replace the company's overall profit, or replace the company's profit on export sales with the company's overall profit worldwide. And the reason for that is when Congress wrote these rules, they did not want to penalize companies for trying to break into a new foreign market. A lot of times that they may have more costs related to shipping, or more costs related to just doing business outside the U.S., or they may be more have more pressure on the actual sales price going into a new market. So Congress said, well, if that's the case, we'll let the taxpayer replace the worldwide profit on the similar product, and use that in determining the commission amount for a transaction.
Hey, Eric, I got a question. Oh, you're okay. You're going to do that. This is exactly. It's great to talk about it abstractly, but an example will be helpful. And thank you for that.
Yeah. So this is a very high level example of how we compute a commission for a company. This is would be for the entire year, all the company's export sales here. So we've got $1 million of total sales, and this company is selling widgets and gadgets. So we've got widgets and gadgets, $1 million, and the related cost of sales. So the cost of production to sell the product is $675,000. So we have to take that into account in determining our profit on our export sales. Our gross margin is $325,000. So that's $1 million less the $675,000. And then we have to take the company's operating expenses and apportion those operating expenses to the export activity to determine the net income on your export sales. So these operating expenses further reduce the profit, the gross margin, down to $200,000. So we've got a $200,000 profit on these export sales. The overall profit percentage here is 20%. So we've got 200,000 divided by 1 million, 20%. If we apply the two methodologies here, the 50% of net profit method or the 4% of gross receipts, you can see here if 50% of our 200,000 is $100,000 commission, or 4% of the million would be $40,000 of commission. So you can pick and choose which method you want to use. And here, obviously, $100,000 would be the better method. So if we go back to those previous slides where I was comparing the difference between ordinary income rates and qualified dividend rates, where we were at about 30% for ordinary income versus 24% for qualified dividends. So the spread would be 6% on the 100,000. That would be the permanent tax savings that you would generate on the DISC commission for that year. So this is another example. I mentioned the idea of looking at this on a transaction basis, and this is still pretty high level, but I wanted to just walk you through this just to give you an idea of what we can do when we start looking at this in a little more detail. So these are the same numbers that we just looked at on the previous slide. Total numbers are all the same. $1 million of revenue, 675 of cost of goods sold, 125,000 of SG&A. If you split that out between widgets and gadgets, you can see in this case the company is more profitable on widgets than it is on gadgets. So here we're permitted to apply the 50% method on our widgets, and that gives us the highest commission, the best answer. And here we're using 50% method on our gadgets, but the company overall is profitable at 20%. So if we used the company's overall profitability and applied that to our gadget sales, that actually gets us to a $50,000 commission. So 20% of 500,000 is 100,000, and using the 50% method here would get us to a $50,000 commission. So instead of a commission of 100,000, just looking at the export sales in total, breaking it out between the two product lines and using marginal costing, we're able to claim a commission of 122,000 here in this scenario. So you're able to really dig into the details when you do these calculations. The more detail, the better. There's also a lot of opportunity to optimize the allocation and apportionment of expenses here. So that's one thing that we'll do as well. We'll go through a company's trial balance.
Aaron,
yeah.
Before you go on for that, I just want to make sure everybody, or maybe just me, that when you say the highest commission, 122,500, that explaining to us, that means when you have a disc, where does that $122,000 go to next, and how does it get to my company?
Yeah, I'm going to show you here right now.
Oh, okay. Sorry, I'm just trying to make sure I understand it.
Yep. So I'll walk you through some scenarios here of how this is set up, and I'm a visual person, so hopefully this helps as well. So this is a typical structure. We'll talk about LLCs that are taxed as partnerships, as well as S corporations here, and we've got a couple other structures that we can walk through as well. But I would say most of our DISC clients, the majority, are either LLCs taxed as partnerships or S corporations, and usually the DISC is a wholly owned subsidiary of that operating company, whether it's an LLC or an S corporation. So the way it works is if we go back to our commission, 122,500, that commission, once we determine what that number is paid to the DISC. We actually want to see the cash move, so we'll have the DISC. The DISC will have its own separate bank account. It'll be paid to the DISC. The DISC, again, recognizes that income, but it's a tax-exempt entity, so it pays no tax. This commission right here is a reduction of your ordinary income to the business. So this is going to reduce the ordinary income that flows through on the K1 to the owners. The DISC will then distribute the dividend of the same amount. So the 122,500 will go back to the LLC, and that dividend is a qualified dividend. So that'll be recognized on the K1 of the owners as a qualified dividend. So the 29%, the benefit here is a reduction of ordinary income taxed at 29.6%, and then the qualified dividend is paid and taxed at 23.8%. So it's a circular flow of cash. We sometimes, maybe leave the money in the disc bank account for a day. It doesn't need to stay in there for very long. There's no reason to have it in there longer than you need. So there really is not much in the way of a cash flow issue for most of our clients that have this. So this is the same scenario here, only the related supplier is an S corporation. Here we've got the commission going to the disc, reducing ordinary income that's recognized on the K1 for the shareholders, and then the disc pays a dividend back to the S corporation. So that payment triggers the deduction for the year, and then the dividend is recognized when the payment is made from the disc back to the S corporation. So this is a different scenario here. This would be for companies that are U.S. exporters but have been set up as a C corporation. So a C corporation is a taxable entity. It's not a flow through. It'll pay a corporate level tax, and then shareholders will pay tax again on any distributions of earnings paid out of the C corporation. So dividends paid out of the C corporation would be taxed at the shareholder level. So there's that concern of double taxation for C corporations. You have the corporate level tax and then the individual level tax. When you put a disc in place, it can be very powerful in this scenario. So here, the disc is not a wholly owned subsidiary of the C corporation. Instead, it's a brother sister entity, typically with the same shareholders as the C corporation. So we go through the same process for the C corporation and computing the commission for the year, and that commission is paid to the disc. The disc again pays no tax, and it distributes a dividend up to shareholders. So that dividend is taxed the same way it would be taxed if it came from the C corporation, but with the disc, we get a deduction for the same amount of the dividend paid. So that effectively reduces the corporate tax by the amount of the dividend that's getting paid to the shareholders. And I think an easy way to think of this is this payment here is a tax deductible dividend going out to the shareholders. So it's a very tax efficient way to get cash out of a C corporation as in the form of a dividend going through the disc to the shareholders. We've done this for a lot of our clients. The corporate tax rate right now is 21%. That's very low. I mean, if you think about that compared to 29.6% in a pass-through or flow-through structure, that 21% corporate rate plus the fact that you get tax-deductible dividends going through a disc is a very powerful and tax-efficient way for U.S. companies to manage their export activity. So when the 21% became in effect with the Tax Cuts and Jobs Act in 2017. So when that got put in place, we worked with a lot of our clients that may have been S corporations. They may have been S corporations before 2018. And they saw that, 21% was now the corporate rate. They were heavy exporters. You can get your effective tax rate down pretty far with this structure below that 21% rate. So just something to keep in mind. If you're a heavy exporter, this structure is very tax efficient right now. Now, this 21% corporate rate has been challenged by President Biden. He's issued two Green Book proposals. There was proposed legislation at the end of 2021 that would have brought the corporate tax rate up to 28%. That didn't get passed. That legislation got killed, and it hasn't been brought back again. But in the most recent budget plan in 2024, there was again a corporate income tax increase. Now, that's not in effect or anything, but as you can see, that corporate tax rate is something that's I guess as a target for legislators to try to generate some tax revenue. So this is another structure that we have for some of our clients that are foreign owned. So this is again a U.S. corporation. The DISC regime is all about U.S. companies producing product goods in the U.S. and then selling to foreign persons. So we still have a U.S. company that's exporting here. It's just a subsidiary of a foreign corporation. And in this scenario, the DISC, if we put a DISC in place, it could create that corporate tax deduction in the form of a commission. So we have the commission paid to the DISC, and then a dividend up to the foreign parent. That dividend, if it's to a country where the U.S. has an income tax treaty, would be subject to possibly lower withholding tax versus a 21% tax rate. So, for example, there's say Switzerland, a dividend from a U.S. corporation to a Swiss parent is subject to a 5% withholding tax. So instead of a 21% tax rate, you have a 5% tax rate. In the UK, that dividend withholding tax is 0. So you have a corporate tax deduction here at 21% in the form of the commission, and then a very low effective withholding tax rate on the DISC dividend going up to the treaty parent corporation. This is another foreign-owned structure. In this case, it's the same concept, only we have foreign individual shareholders that own the DISC directly here. So again, you would likely get treaty withholding rates if the foreign shareholders were in a treaty country.
Hey, Eric, we have had a question. Would you be willing to share the slides with attendees after the fact?
Absolutely. Yep.
Okay, thanks.
Yep. So this is another structure here that we've implemented for some of our clients. And a lot of times when we think about this structure, it's in a scenario where there's may not be a benefit from implementing the DISC because, say, the related supplier has implemented an ESOP, which is an employee stock option program. So essentially, when you implement an ESOP, there's actually no federal income tax on the profits of the operating company. So there's no benefit from a tax rate arbitrage by setting up the DISC. But what we can do is create a structure where we can benefit the say key management of the company. So the individuals that are running the company can possibly benefit from the DISC, and there's no requirement that the DISC is owned by the same owners of the operating company. There's a requirement that the DISC is under the same control. So if you think about that, we've got key management running the operating company and key management owning the DISC. That would create common control between the two entities here. So when we set this up for our clients, we have the operating company that's producing product and selling it to foreign customers, paying a commission to the DISC. And usually we'll set up a partnership here to own the DISC. But the benefit here isn't really necessarily to the company. It's really to the individuals, because typically these individuals are at a level that may be receiving maybe compensatory bonuses on an annual basis. Those are ordinary wages, taxed at the highest ordinary rates. 37% is the highest ordinary rate on wages. It would essentially possibly put a dividend in place in lieu of a bonus. So you're replacing the bonus with qualified dividend income to the individuals here. Their individual tax goes down because they're taxed at qualified dividend rates versus ordinary income rates. And we've set this up so that the LLC allocations here can reflect the annual bonus awards. So essentially what we've got now is executive bonus compensation being converted from salary or wages to qualified dividends. Very powerful for situations where we have, the ESOP is the most common, but we've also done this for in private equity instances as well. So this is just the math of the tax rate arbitrage for a pass-through structure. We've talked about this several times. We've got active shareholders here in the first example column. The commission in this scenario is $500,000. We have a 29.6% benefit here. So tax savings of $148,000 on that $500,000 commission. The dividend is then taxed at 23.8%. So we've got tax coming back here at $119,000, and the spread here is $29,000 net benefit. So our deduction is greater than our tax deduction benefit is greater than our actual tax from the qualified dividend. Effectively, that's about a 6% of the commission. So 500,000 times 6% is roughly $30,000 benefit. For passive shareholders, they're already subject to the net investment income tax, so their ordinary income is a little bit higher. That actually creates about a 10% benefit for passive shareholders in a pass-through structure. So LLCs and S corporations, this is how the benefit plays out here. And this is just an example of a C corporation that's an exporter with and without a DISC. So without a DISC, we've got that corporate level tax, 21% of $500,000. That reduces the amount of earnings that's allowed to be distributed to the shareholders. So $395,000 distributed to the shareholders. Shareholders will pay tax on that $395,000 qualified dividend. So the actual cash that's going to the shareholders is roughly $300,000 without a DISC in that scenario. With a DISC, there is no corporate tax because we get a tax deduction for the commission, and then the shareholders will pay tax on the qualified dividend, and then the actual net cash to the shareholders in this scenario is $381,000. So roughly about a 16% benefit for individuals that utilize the DISC through a C corporation. We talked about this a little bit. So there's ways that we increase our commissions for our clients. You know, the transaction by transaction analysis, product grouping, and detailed expense allocation and apportionment. There's ways to create temporary benefits, so you can defer that DISC dividend by either issuing a special loan that a DISC can make called a producer's loan, or by factoring receivables. Again, consider using the DISC for compensation purposes, so that compensatory DISC idea is something that can be pretty powerful. With a C corporation, you not only get the benefit of tax deductible dividends through commissions that are paid to the DISC, but we'll talk about foreign derived intangible income here shortly. That's also an incentive that's available for C corporations that are exporting. Consider conversion from the pass-through structure to a C Corp. And then we will we'll move on here so we can get to the foreign derived intangible income section. These are just requirements of a DISC. It must be a domestic C corporation. That's plain and simple. It can't be an LLC, can't be an S corporation, it has to be a domestic C corporation. The C corporation has to make a timely election to be treated as a DISC. So that's a form that's filed with the IRS within 90 days of the beginning of the tax year, 90 days of incorporation of the DISC. We usually set up a separate bank account. There's a $2,500 capital requirement, so $2,500 would go in for the stock of the DISC. We would leave that in the DISC bank account. You can only have one class of stock. There's a limited amount of activity that a DISC can have, and it must be the qualified export asset and qualified gross receipts test each year. There is an actual tax form that's filed for the DISC. It's an 1120 IC DISC. It's due for calendar year taxpayers on September 15th each year. There may be some state filing requirements. We do file state returns for our DISCs that are located in Indiana. We'll file an Indiana return, but Indiana does follow federal statute for IC DISCs. So Indiana does not tax the DISC income either. So Indiana is a very favorable state for a DISC to be located. So what activity qualifies for the DISC? So this is the operating company that's paying a commission. The qualifying activity is typically the sale, exchange, or other disposition of export property. And we'll get into the definition of export property, but you can have a sale transaction, you can have a lease or rental of export property. Services are qualifying as long as they're related in subsidiary to the sale of export property. And then there's also accounts receivable factoring and interest income from a producer's loan. These are all qualifying receipts that we can put into a DISC. So export property is property that's been manufactured, produced, grown, or extracted in the U.S. by a person other than a DISC. So if the operating company is making the product, then that's the manufactured step there. It could be that another entity, an unrelated entity, is the manufacturer, and the operating company that has the DISC is simply buying the manufactured product that's been manufactured in the U.S. and distributing it to customers outside the U.S., and that can qualify as well. It has to be held primarily for sale outside the U.S. So that could be a direct sale to your foreign customers, or it can go through, again, a distributor. So I have several clients that will sell a product to a distributor in Laredo, Texas, and that distributor will take the product and sell it to customers in Mexico. As long as that distributor is not modifying the product before it sells it on to the customer in Mexico, then that sale is held for use or consumption outside the U.S. So that would be a qualifying transaction. And then there's a foreign content rule. So the cost of foreign content that goes into the product that's manufactured cannot be greater than 50% of the fair market value of the final product. So the fair market value would be your sales price. So if you're importing goods, and the cost of those imported goods are greater than 50% of the sales price of your final product, then you would not, that product would not qualify for purposes of inclusion with a DISC. A couple other things here. There's an interest charge on DISCs. That's for any accumulated earnings that are left in the DISC for more than 1 year. Again, I mentioned the limit on the amount of earnings that can stay in the DISC. It's related to profits on $10 million of qualifying gross receipts. Most of our DISC clients are paying the commission to the DISC and then immediately distributing the earnings back out to the shareholder of the DISC. So we don't necessarily deal with this very often. I mentioned state income taxes, that those have to be taken into account. Indiana is very favorable though. So foreign derived intangible income, we'll talk about this real quick, and I'm happy to take any questions here if we have time at the end. Again, this was a new deduction that's available to U.S. corporations effective January 1, 2018. So it's been around for a while now. Essentially, what it is a tax deduction that's equal to 37.5% of the foreign derived intangible income that a company can generate. And again, this is only available to U.S. C corporations. So any LLCs or S corporations, any pass-through entities, this is not available for those essentially individuals. It has to be a C corporation. There's three main components here: deduction eligible income, the deemed tangible income return, and then foreign derived deduction eligible income. So this is essentially companies' taxable income. The deemed tangible income return. So this is a concept where, again, we're focusing on intangible income. So there's this idea of a deemed amount. How much should a company make on its tangible income or on its tangible investments? So essentially, this is 10% of a company's investments in fixed assets or tangible deduction eligible property. So 10% of the net amount. So if you have, say, a piece of equipment that's $100 and you've depreciated that over a number of years, and the accumulated depreciation is $50, then the net value of that property is $50. The deemed tangible income return would be 10% of that $50 amount, so $5. So we'll show you how that goes into play in determining your foreign derived intangible income, but that's a concept to understand as part of this. And then the foreign derived deduction eligible income is essentially your income that's generated from foreign sales of property, foreign services provided, so services provided to your foreign customers, or foreign royalties. So if you're generating royalties from foreign persons, that can also qualify. Again, I'm visual here, so this is a formula for determining what that deduction is under the foreign derived intangible income regime. And what we do is we start out with net income. So we determine our net income, and again, we reduce that by our deemed tangible income return, 10% of our fixed assets, and then we multiply that by our foreign derived eligible income, so our foreign income, divided by our total. So we determine a ratio here, multiply that by the net of the deemed tangible income return, and that's our foreign derived intangible income. Our foreign derived intangible income then is multiplied by 37.5%, and that's the deduction that we get at the corporate level for our taxpayers. And this has been an incentive that has really generated a lot of benefit. There's no need to set up a separate legal entity in this instance. With the DISC regime, you do have to have a separate legal entity. This is just a deduction that's available for U.S. C corporations that are either exporting property, selling services to foreign customers, or licensing their IP to foreign persons. So as part of the Tax Cuts and Jobs Act, this deduction, the rate of the deduction is scheduled to sunset down. Right now, it's 37.5%. After 2025, that reduction or that deduction is going down to 21, essentially 22%. So from 37.5% to 22%. So this amount will be lower. The benefit will likely be lower as well. So one thing that differentiates foreign-derived intangible income versus the DISC has that made in the USA requirement, and foreign-derived intangible income does not. So this could be, an export product that essentially is imported and then resold to a foreign customer. That could be a qualifying sale. There does not have to be any domestic content in the product to qualify for this deduction. So it is a little more, I guess, lenient in that regard, but it still is providing a benefit to companies, and I still think it's providing an incentive for companies to keep product and profits in the U.S. and indirectly creating jobs in the U.S. by having the U.S. companies sell product, whether it's made in the U.S. or not. This is still beneficial for companies to take advantage of.
So Eric,
Yep.
We're about 3 minutes till.
Yep.
Would you mind if we just open the floor for any questions that our participants have not decided to put into the chat? I think
Sure.
we've answered everything that was in the chat. If any of the participants want to ask Eric a question here real quick before we conclude, feel free to unmute yourself. It might be nice if you have a camera to show yourself and ask the question. Okay, I'll take that as radio silence, as it were. Eric, just want to thank you on behalf of the Indiana District Export Council. We really appreciate your time today. Thank you for doing this for us. I quite enjoyed it myself, but ironically enough, I enjoy tax. So, and I'm not an accountant, so go figure. I do appreciate this, though. I think this is very helpful to our participants, and just want to remind all of you that we, if you go to our website, we're happy to. We have a list of events coming up. Please feel free to join us in the future. Eric did indicate during the talk that we would be able to share the slides, so we'll get those out to you. And if there's really nothing else at the moment, again, we